Today we're going to continue our discussion with our 50 pips a day trading strategy, and we're going to be going over the 6 P's of preparing for your trading day. Stay tuned, traders. We'll be right back. G'day traders, I'm Stacy Burke from Stacy Burke Trading. Some fantastic movement in the markets this week as we've seen the last couple of days. Today, Wednesday, we're probably going to have some other big moves again. There's still a lot of pensive activity in the markets, a lot of explosive moves, especially on the British pound crosses yesterday. I'm expecting to see some similar behavior over the next few days. Continuing our discussion, yesterday, the day before, we started talking about numbers, going over our levels each day. We're going to go a bit more in depth in preparing for the trading day. We're going to talk about the 6 P's of preparation. A friend of mine who's in the Special Forces, he said to me, the 6 P's of preparation are piss poor preparation equals piss poor performance. And my response to that is that proper preparation helps prepare you for performance. And that's what we're going to talk about today. Preparing for your trading day. Now, we've been going over the charts each day, demonstrating our levels where we are identifying what we see as the 100 pip box on the pound cross pairs, even though with the Aussie, the New Zealand cross rates, they may be in a 300 pip box. But it's about identifying the 00 areas that the market potentially is going to be either trading for buying low to selling high, or selling high to buying low. Now, the last few days we've seen some very big moves. We're going to talk about the 3-hour cycles because we've seen them. Last night was a great example of a 3-hour move, and then the second 3-hour block extending that move out even further into the US Open for some fantastic trades back against the trend. So the first thing we talked about preparing each day is we talk about structure. We want to know, is there any bigger picture geometry in the markets? We've talked about looking for head and shoulders type patterns, whether they're reversal upside down ones or on top. We've had some 3-push and some 4-push patterns setting up on the US cross pairs, bigger structure. We've talked about descending triangles. We've talked about ascending triangles. The Aussie dollar right now, great example of an ascending triangle. We're going to go over that today. Okay, we've saw double tops, double bottoms. Okay, great example on the euro on Monday of a double bottom. And rectangles. So those are just some of the bigger picture structures, because when we get the bigger geometry and we can tie that in with the high and the low of the day, because we know that's where a lot of the orders are. So we talk about identifying the 100 pip box. What we're looking for is potentially either a market that might be putting tails down inside of a box down below, so they're obviously buying it up off of this level, or potentially even selling it above the box with tails going up to the 50. So we're going to see different variations. We might see the tails down below at 50 with a bear candle, and then we might see a bull candle come beside that combination. But again, we talked about engulfments. Down at the lows or at the highs, where we see a reversal pattern completely engulf a candle in combination with the other price action before the market reverses. But the first thing we want to look for is, are there any tails? Are there any tails up top? If you see 3 tails on the bottom, you should start looking at the numbers. If you see 3 tails on the top, start looking at the numbers. Where are we trading? We're always looking at 00 boxes. So structure, high of the day, low of the day, 00s, 50s. Does that mean that there aren't going to be trades off of 50? Absolutely, there's trades off of 50s. You may have a sell signal where the market has come down from the previous session. There's a high in place we might see the market auction up into 50 before selling off above the 00 box, where there may be an engulfment at the 50 level. And again, the market's going to throw tons of variations at us, but the two areas we want to focus on are 50s and 00s. In my mind, I'm always looking at 00 boxes. I had a gentleman email me and ask me, what do you mean by risk reward? Obviously, we've had a lot of volatility. Our ATRs have increased. On the pound New Zealand crosses, some of the candles are 50 to 100 pips. But your risk reward on those trades may still be 3, 4, 5 to 1. So you can reduce your trading size. And on those two pairs, I will go down to smaller time frames within that 12 candle window. So when Europe and London open up between 2 a.m. and 5 a.m. on those particular pairs, when we're near the low or near the high of the day, I will go to a 5-minute chart to look for the same patterns near the numbers at the low or at the high. Now, risk reward. If we're down in we get a trade at 00s, okay? The minimum target on that trade is 100 pips. Okay, the ATR comes into play for your instrument that you're trading, the average true range or the average daily range, however you want to phrase it. And then we tie in some of the structure for that particular day. Yesterday, the pound Aussie had a beautiful double bottom pattern. It gave a nice pin hammer on the right shoulder. There was a measured move to the 2840 or 9840 level. Okay, that market went up through 9,900. That was over 250 pips up from the numbers. So even though you were risking 50 to 75 pips on the 15-minute chart, traders who got in on the 5-minute chart got a better fill, but they were still targeting 5-6 times their risk. So again, some of the U.S. pairs are going to give some great trades. The U.S. dollar had a huge run over the last few weeks. When the market crashes, the U.S. dollar gets strong, those cross pairs get weak, especially New Zealand, Aussie, Canadian. Canadian dollar is a currency that reflects the oil price to a large degree, so as long as oil stays weak and U.S. stays strong, we may see some volatility in the Canadian dollar as well. But the pound crosses, again, that 3-hour window, we saw that initial breakout. There was a news release yesterday at 5:30 a.m. New York Eastern Standard Time. That market eventually broke through that 150 pip box, moved up, but then after the 3-hour window, instead of coming back and stop hunting in, it extended out through the range. So we talked about the 3-hour windows. The market will often stop hunt a high or a low, extend a move out over that 3-hour window. So if you have a breakout in the Europe-London transition and the market breaks to a new high or to a new low, start counting timing in your head. Even though you're on a 15-minute chart, we talked about the hour phenomena, start thinking 1 hour, 2 hours, 3 hours. If at the end of the London hour, your market is up 50 pips, and then these markets may be 100 pips, and the next hour afterwards, that market is going sideways, you may be getting in, that market may be getting ready to stop hunt back. If that market continues to extend out even further, you may see that market now trend another 3 hours or trend for an hour and consolidate over the next couple of hours. As we saw last night, we saw some big moves on the pound Canadian, pound yen, pound New Zealand, pound Australian, and some fantastic opportunities shorting those markets back against the trend on some big pinned candles just prior to the US Open. So again, preparation, mark off your levels, rehearse. What are the two scenarios that you can foresee in that market? Are we potentially seeing the market, has it in the previous session given us an example of breaking out of the box and pulling back in? Are we working the bottom of the box for a move up? Is the market pushing down through the box and consolidating? Has the market broken out and layered on top of a 50 level with tails down below, meaning that it's filled orders through that lower part before moving towards a previous daily high or low? When we talk about risk reward. You've got your intraday high and low. So if we're inside of a 50 pip box, normally you're going to be at least a 50 pip extension. Normally for me it's 2 times the range you're trading in. But if we break through other geometry from the previous day's high or lows, we could be in for an even bigger move. And that's where we talked about trying to squeeze as much out of your winning trades as possible, cutting your losses short. But the most important thing right now is getting into a routine of preparing, marking your levels off, having a thesis for each one of those pairs. Doesn't mean you have to trade it. Rehearsing those scenarios. Then we talked about the things that will happen to you in live time with the market. They'll flash the prices. They'll use fast moving momentum on candles. They'll spike down low, spike up high without hitting lows or highs. They'll hold the price at certain levels. They'll widen the spreads. They'll flash price at certain levels to get you to second guess even when you're in a really good trade. And then performance. The next step is actually doing it in live time, confidently and calmly with a pre-game plan. And if the market plays into one of those scenarios, once it's confirmed your thesis for a trade entry, then fighting for the best price. That's where this preparation, rehearsal, performance comes in, because you're not going to get it right every time. You're going to make mistakes. You're going to get scared out of taking trades. You're going to chase poor fills on a price. It doesn't mean the trade is wrong, but you're going to chase poor fills. Then you're going to get better at it. But you need to have a little routine to keep improving upon that each trade that you take. And then reviewing that process, reviewing the results, and then also trade management. So even once you're in the trade, are you getting shaken out of a winning trade because of the volatility? Are they coming back and stop hunting you with a momentum candle even though they don't take out your stop? Are you getting out because you want to take something off the table and then you watch the market run away without you? Little things that are going to come from experience day after day after day in live time. And remember, we only want to focus on the highest quality setups. Now you may need to build a playbook of 2 or 3 of the same patterns that you seem to identify with best, that show up over and over and over again. And you're going to start to recognize that the same patterns happen almost all the time, just different variations of them. So again, the 6 P's: piss poor preparation equals piss poor performance. Proper preparation equals proper planning and execution. So hopefully that gives you a bit more insight, traders. Remember the 3 things that markets do. They break out, they trend, they break out and they fail, false break, and they reverse to the other side, or they break out and they pull back and they go into a range-bound market. Those are the only 3 things that are going to happen. So when you're trading in that 100 pip box and you've got a thesis, you're identifying the candle formations, the timings are what's important. When that transition happens, do you have a price area where you can get the best fill that once your trade entry's been confirmed, put your stop in place, manage the trade to its target, have an asymmetrical risk reward. We talked about using the measurements. It's not a Fibonacci tool. I've had a ton of people email me asking me what my fib settings are. It is purely 100% expansions of the range. So I've got 100, 200, 300, 400. I just drag the tool from high to low. It gives me a target for 1 or 2 times the expansion. So keep it simple, traders. Timings, round numbers, highs and lows, asymmetrical risk reward, 3-hour windows. Stay disciplined, stay focused. We'll look at a couple of examples from yesterday. And in the daily FX levels, we're going to go over the pound cross levels for today. Have a great trading day, and may the markets go with you.
Good day, traders. Stacy Burke from Stacy Burke Trading. We're just going to review a couple of trades from yesterday and just again demonstrating tying in structure, the high and the low of the day, the round numbers and the timings, and then asymmetrical risk reward type of candle patterns that we're looking for. Yesterday on the pound Canadian, we saw a great example of structure. We had a high and a low from the previous session. The market pulled back and had gone sideways between the 100 pip box. We knew there was stops above. We obviously knew there were stops below as well. not only below the low of the day, but below the last swing low from the previous session. We had a high painted in the Europe changeover prior to the London market opening. When London opened, we saw pins on the bottom. We already had stayed, the market had broke above. We're in the 00 box, we have a big pin. If you look at this again in terms of our high and our low, we're inside of a 100 pip box. We can consider that 50, the 50% level of that bigger structure. The market had put pins on the bottom and then went up on top and layered on top of 50, gave a pin to the top. Sellers would have been in the market. Again, an example of after a certain amount of time having evolved in that market, not breaking through to the lower part of that box and then painting pins on the bottom and then a double pin hammer. That breakout is an entry confirmation long for traders. Now, an example of targeting risk reward, again, if I was to take my measuring tool and just drag from the high to the low, this isn't Fibonacci, it's just 100% expansions of that range, 100, 200, 2 times my target would take us up to that 70-10 area, and you can see there was stops up there from the previous day's highs that the market was targeting. But more importantly, the entry, once the market broke through and cleared that high, we want to be going to break even. That market, once it's gone to a new high, is vulnerable to returning back or breaking through. That market went quite quickly through, straight through to the highs, which typically, if it's going to break out and move and go strongly, it should not come back. And that market moved very strongly up into the beginning of the U.S. session. Half an hour before the U.S. market opened, we had a pin paint, and that was 100, 200, 300 pips above the breakout. Again, you want to ask yourself, have we met or exceeded the average daily range? This is an example of the market moving 3 hours and then moving another 3 hours. This is a great opportunity with a pin to the 00s for a sell high setup. The first target would be the low of this pin hammer. So traders who are long obviously have stops underneath, but also that market has nothing to target. 1, 2, 3, you want to be at break even after 3 bars, and then boom, straight through to the low. That was a 100 pip move down. So if you didn't get in on the long trade, again, we had a bit of a ascending triangle build up as well. We may see a continuation of that today. We'll talk about that in the daily FX levels video. But again, pin high prior to the US Open, round numbers, 3 pins at the high after the average daily range had been met or exceeded. Great opportunity to participate in a stop hunt back into the trend. The pound yen gave us a great example of a similar trade. We had a symmetrical triangle prior to the open. The market moved up, took out the high, and then continued to do a measured move. And if you look at the structure of that rectangle heading into that squeeze, we had 2 smaller patterns inside of a larger structure. Not only did we have the double bottom reversal, we had a rectangle. If we were to put our measuring tool on that rectangle, again 2 times that range, we'd be looking at a minimum of going to 129.75 area. Now the other option is to look at doing one complete measured move of the larger breakout rectangle, and that would be targeting 30.20. Again, with a move like this, when it moves that strong, traders may want to, once it hits a level, follow those bars underneath of the lows of the day. And again, trapping as much out of these moves as you can. We had a micro trend line break just prior to the US market open, so I leave this, it's a micro trend line, nice and tight. The first break, we should see a retest of the high, at which point you can redraw your trend line. New highs are made, we respect the most recent low. Then the market, just after the US market opened, we had an engulfment pattern, and I wanted traders to see that when we get a 1, 2, 3 and there's pins inside, a stop hunt on that breakout candle, Whenever you get 1, 2, 3, we've talked about this. It's either a stop hunt or a blow off. So if it's a continuation, you'll get an inside bar and possibly a measured move. In this particular case, we had pins on the bottom. That's a dead giveaway. You want to be going to break even at a minimum, because that market will come back very strongly. So if you get a counter trend trade and after 45 minutes, if you can see a 1, 2, 3, and that market's giving evidence of possibly reversing against you, you want to be prepared for a fast, strong move, because once that reversal's taken place, the market will move aggressively in the direction that it's heading. Pound Aussie. Again, this was a trade that I took yesterday, and we'll talk about some trade management. This market came down, gave us the double bottom with four or five pins on the bottom. The pin hammer, even though we had the large candle, we just adjusted our position sizing. We tried to get filled as close to the numbers as possible. I saw on the 1 minute chart there were gaps. I knew there was going to be some heat on that trade, but the measured move on that trade gave us a very nice target up around that 98.60 level. The other possible target that traders can target is one full expansion of that last high before the low. And again, that gave us, that target was also met. So again, with some of these trades, you're going to have to make some discretionary decisions. Sometimes you get it right, sometimes you get it wrong. I was in this trade, break even when it had gone to the upper 100 pip box. This candle, when it again reversed after a certain amount of time, I decided to cut the trade at 75 pips, knowing that this had the potential to move over almost 300 pips. And again, sometimes you make decisions in live time, you live with them, you learn from them, you just keep getting better. Sometimes you get it right, sometimes you don't. But I was still happy with the trade, but my trade management could have been better. So again, another example at the US Open of pins flipping the book. So we had pins on the bottom, strong, huge moves, and then all of a sudden pins on the top. This pin on the bottom tricks traders into chasing the trend up high. Again, average daily range has been met or exceeded. Then we get our pin hammer. We talked about the 1, 2, 3, and then bang. That candle immediately stop hunted traders, and it will do it fast when it's right, because these traders are trapped, and when they're going to go after the money, we had the stop sitting down underneath here at a minimum, and then breakout traders. These trades will move quickly, but again, looking for tails, flipping the book just prior to the US Open. So again, screenshot some of these trades. Start identifying where you see the tails flip from one side to the other. We're seeing some tails present here already at the same level. Day 3, we may see a retest of these lows today. We'll talk about that in the Daily FX video next. Stay disciplined, traders. Keep getting better. Round numbers, measured moves, asymmetrical risk reward, 1 bar stops. Keep it simple. May the markets go with you.
Hi traders, it's Stacy Burke from Stacy Burke Trading. If you haven't done so, please head over to my website at stacyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.